This is level 2 of the CFA program, the topic on portfolio management, and the reading on backtesting and simulation. I want to begin by telling you a quick story about my father. And I want you to bear with me because this story has something to do with backtesting and simulation, although at first glance it might not appear so. My father was an average athlete who loved playing golf. And he was that interesting golfer who, while he was on the driving range practicing his swing, could really swing really well. He could hit the ball straight and far, but he couldn't quite pull it off on the golf course. He would overswing and he would jump at the ball and he'd hit it all over the place. And it was really kind of funny because he was always so disappointed in his performance on the golf course. But when we were on the driving range, he would look at me and he would say, "You remember yesterday when we were on that par 5 and I was in the middle of the fairway? If I could just have swung like this, I would have hit it on the green and maybe even had an eagle." And then he would say, "Tomorrow we're going to play this new course and I'm going to play this par 5. I'm going to do this and I'm going to swing just like this." And of course, you might be asking yourself, what does this have to do with backtesting and simulation? But here's the story. Of course, my father can't go back to yesterday and replay his round of golf, and he can't go tomorrow and future play his round of golf, unless, of course, he can get in a time machine and go backwards or forwards, although I'm not quite sure that might even work. Because you can't duplicate the problems of yesterday and the problems of tomorrow. So I use my data as an example to illustrate some of the problems with backtesting and using simulation. But look, in this world in which we live now, we can backtest and simulate because we can look at history and we can compare it to the current events and we can look at possible futures and compare those to the current events. Let me just give you a quick example, and this will be illustrated throughout the slide deck. Let's suppose we're some kind of a value wealth manager and we decide to take the long position in, let's say, the top 20% of those firms in terms of a dividend yield. And then we want to short the bottom 20%. So we'll take long and short positions based on this strategy. Well, what we can do to backtest is we can say, all right, let's pick a time period over the last, 3 years or 5 years or 10 years that looks an awful lot like the current time period. And let's go see what that strategy would have done back during those time periods. And that's essentially what backtesting is. Simulation, on the other hand, is to say, all right, we have this strategy now. Let's simulate future possible outcomes. Maybe if interest rates go up. Maybe if the price on credit default swaps go down. Maybe if the Fed tightens. Maybe if the Fed weakens. Maybe. So we're simulating based on potential future variables. And that's really what this slide deck is to go back in time and see how well we would have done in the past and go ahead in time to see how well we might do in the future. Now again, let's go back to my dad's example. These are excellent tools, but they're not perfect tools. Just like my father cannot get in a time machine and go back and replay his round from yesterday, using backtesting has some limitations because it's super difficult to find an historical period that's exactly like today's period. Of course, you guys should be thinking, all right, let's suppose that we're doing this dividend yield strategy that I came up with. Well, we're coming out of COVID. Let's go back and find a period where we came out of COVID. Well, it's difficult to kind of reproduce that. However, so I want you to think about this. They're great tools, but they're not perfect tools. And as we look through the learning outcome statements, you'll see those words in there: backtesting, scenario analysis, historical simulation, and sensitivity analysis. So really what we're trying to do is say something like, all right, this is what we know. And this is what we knew in the past, and this is what we hope to know in the future. Let's combine all of that stuff so that, now you ready for this? So that we can act as better financial stewards of our clients' capital. All right, let's go ahead and remind ourselves in a brief recap of what these definitions are and what they mean for us here in level 2, although I think my 2 examples are probably self-explanatory. All right, backtesting. test the performance of a strategy over a long time period. And so that's difficult to find a super long time period. Of course, length is better than brevity when we're back testing. But then you get into the notion of, all right, during that lengthy period historically, what kind of dynamic changes occurred that we know of, and are they reasonably expected to repeat themselves from today going forward? We can also do historical scenario analysis where we could say something like, all right, we know what happened back then, and let's find specific events, like in this example, a recession or periods of high inflation, and let's see how our current strategy would have performed under those historical scenario analyses. Simulation, hypothetical environment, and then sensitivity analysis, revising key assumptions like price of oil or Fed tightening or weakening. Those of you who love math and graphs will probably grasp onto this one here. Notice over on the left-hand side, we have some inputs. So those are input variables like x1 or x2 or x3, and they could be almost anything that you could think of. And then how do we use simulation and how do we use sensitivity analysis? Well, for simulation, what we're going to do, look, instead of looking at those inputs, now we're going to look at the functions of those inputs and see how they output. And that's why over on that top right, we have the F in there under before the x3 and the 2x and the 1x. Down below, under sensitivity. So with simulations, we're dealing with probabilities and probability density functions. But with sensitivity analysis, all we're going to do is we're going to change a variable, x1, x2, and x3, see how it relates to the function, f1, f2, f3x, and then ask ourselves, do we really care about it? Notice on that middle block over on the right, no impact. So we would say, you know what, that's probably valuable information that will have no impact if we change, let's say, oil prices or something. But then what's even more important is that we can determine whether there are large or small impacts and whether they have positive or negative signs. So getting into that first LOS, describe objectives. So I bet we've talked about these. So assesses the viability of a strategy using historical data. Okay, that makes sense, right? Offers insight and rigor. So we do all this stuff about dividends today, and then looking at history, it will offer us some kind of an insight, especially if we've done rigorous due diligence. Historical efficacy, that makes sense. And then this fourth one over on the right acts as acceptance or rejection. We can say something like, boy, we really think dividend yields are super important going forward. But if we go back and test this strategy over, let's say a handful of periods, and every time the output says, Jim, this strategy stinks. It stinks during recessions. It stinks during expansions. It just stinks all the time. Well, then we can reject that strategy. And remember that rejecting a strategy is almost as important as accepting a strategy, because then you know what doesn't work, which then helps you figure out what will work. And so, of course, backtesting suggests that somehow, and I've said this to you many times in previous recordings, is that currently what we have and then moving forward is that that's going to be some reflection of the past. What's that old saying? Those who don't know history are doomed to repeat all of the mistakes that our predecessors made, some of which are tiny, some of which are substantial. Let's take a look at the backtesting process. So what are we going to do? We're going to design a strategy, and so we'll have a set of goals. And so what was my goal earlier? We think dividend yields are important. Here we have on the slide a goal to outperform a benchmark. And so then we need to try to figure out what kind of method or security selection are we going to use. And so we established a set of investing rules, so a trading rule, or choosing key parameters like a dividend yield, or a trading rule that might say something like, when a firm announces a dividend increase, we're not going to buy it today, even though that might be good news. We're going to wait and see what that next earnings announcement is. And then if the earnings does in fact increase, then we'll jump in and buy that share of stock or add it to our client's portfolio. So we have a couple of different steps here. So let's identify the investment universe. Do we want to do this like the Dow Jones Industrial Average? So that would be a universe of 30. Or do we want to do S&P? That would be a universe of 500. Or do we want to do this? Or do we want to do this? Do we want to include bonds? Do we want to include collectibles or artwork? What do we want to do? So let's establish that investment universe. And then, of course, we need to define returns. So let's go all the way back to level 1. Remember, we talked about holding period returns, and we talked about internal rates of return and compounded returns and all those kinds of things. And, of course, we want to decide how we're going to handle investments in different types of economies and currencies. So do we want those returns in the foreign currency? Are we going to hedge those returns? Are we going to hedge half of those returns, etc.? How frequently are we going to rebalance? And then what are our start and end dates? And this, of course, is a function of what the current economy looks like, and then finding economies in the past that look at least a little bit similar like that. Or we can just take a global view of history. And this is why the authors in the reading say, hey, as long as history is possible, well, I'm guessing you could start from yesterday and then go all the way back to the time of Fred Flintstone. Any of you guys know who Fred Flintstone is? You go all the way back then. Well, the problem, of course, is that you really don't have stock prices on a daily basis going back too far. So back testing. So this is a cool thing about the exam is that, of course, you want long periods, but you want relevant long periods. Now, what you can do is that you can simulate history based on what happened in the past. And what you'll tend to do in this process is use some kind of a rolling time period. The reading calls it rolling windows. And there's a pretty good illustration if you want to kind of rebalance or roll during months. And you could do quarters or you could do years. I mean, if you go back to Fred Flintstone, you probably don't want to do months because then you'll have, well, I don't really know when Fred Flintstone lived. That's your homework assignment here before the end of this recording. What year were the Flintstones and the Rubbles neighbors? So my point was that, of course, monthly rolling window sounds like a good thing if we're going back, 3 or 5 years. But if we're going back 20 or 30 years, then maybe you want to do it quarterly or semi-annually. All right, then let's go ahead and figure out how we want to present these results, and we'll figure out which metrics are important. We determined what the return was, so let's go ahead and present those returns. And then risks, do we want things like standard deviation? Do we want beta? Do we want value at risk? Do we want Sharpe ratios? Do we want any of this stuff? So let's put these risk profiles together so that we can say something like, according to what was my thing? Dividend yields today, if we go back there, this 12-month rolling period over a 10-year period, whatever it is, well, this was successful or this was a failure. And then the success or failure depends on those performance metrics. And then, of course, we can have some visual output as well. Now, this is where I think the reading gets super interesting because of all the hard work that we've done over the last several readings. We've done arbitrage pricing, we've done multi-factor models, and so we're going to try to identify those factors that are relevant today. And then we're going to ask ourselves in the backtesting environment, hey, how relevant were they, 3 years ago or 5 years ago or 5 months ago? Now, what the reading does is fairly interesting, I think. It identifies a whole host of different ways to put together a multi-factor equity portfolio strategy, but it zeroes in on two of these. They call them the benchmark factor portfolio and the risk parity factor portfolio. And the reason that these two are attractive, and I'm not guessing that this is too terribly important for the exam, but it might pop in there somewhere, is that these two strategies use equal weighted portfolios so that there is no influence on the asset allocation of those different strategies that are possible. So think about this. Let me give you a quick example. Let's suppose you have $100 and you have 10 stocks. So the benchmark factor portfolio, you're just gonna put $10 in each of those 10 stocks, or alternatively, $10 in each of those 10 factors inside of those 10 stocks, however it works that way. Now, with the risk parity factor portfolio, you still have the same 10 stocks, but instead of having the weightings based on, what did I say, $100, you're going to base that on, let's say, total volatility. And so maybe the 10 stock portfolio has a standard deviation of, let's just pick a number, say 20%. And so you weight those based on risk parity. So according to the marginal contribution of those, you equally weight them based on their contribution to total risk. So the weightings are just a little bit different for each of those, but one is a benchmark, one is a risk parity. Now, the reading then moves on to identify 8 factors. The reading tells us that these are 8 fundamental factors. So we're doing this good old fundamental analysis that we were taught back in level 1 and, of course, level 2 and level 3. And the authors identify these 8. So book to market, earnings, yields and growth, profitability, et cetera, et cetera. You can read those over there. And so look at that second bullet point. A portfolio is constructed by shorting the bottom 20 and investing in the top 20 by each factor. Oh boy, and then each factor is assigned an equal weight. That's for the benchmark. And so the risk parity portfolio is constructed by weighting their risk contribution. In order to do this, you have to have this big old variance covariance matrix. And with risk parity, and this might be a really good question on the exam, is that the difference between the two is that for risk parity, you need all of those correlation coefficients to be able to do that. And you'll use those to rebalance. And you'll see that here in just a second. So you got 2 portfolios, and we're going to back test these. And we're going to say something like, all right, what happens if we form these 2 portfolios over this given time period? Now, we can do this rolling method implemented twice when back testing. So we'll do it once at the factor level. That should make sense. And then once again at the portfolio level. And then look at those 2 embedded circle points here. So for the benchmark factor portfolio, you'll rebalance back to equal weights, but you'll need the variance covariance matrix for the risk parity factor portfolio to rebalance back to those original what did I call those? Marginal contributions. And then the output metrics and visuals, we talked about that. Here's a picture of cumulative wealth. So the benchmark portfolio from 1994 all the way out for a whole bunch of years, a couple of decades, right? So that sounds like a long time period. That looks like it outperforms, right, than the risk parity portfolio. So this is a perfect visual of the output based on these 2 portfolios. And then we can do average returns and Sharpe ratios. We can do as much as we want or as little as we want. But remember, what we're trying to do is capture performance. So we have return, and we have standard deviation, and we have Sharpe ratio. I'm always fascinated when I read about the Sharpe ratio, just from my purely academic standpoint and memory buttons from graduate school, is that, of course, when you compute the Sharpe ratio, you need some measure of the risk-free rate of interest. And so I always ask the question, which risk-free rate of interest do you use? And, the answer almost always is the yield on the 1-year treasury bill because, we deal with annual returns. But if we're doing like this rolling period, maybe you ought to do 1 month in there. Anyway, that's probably not too relevant for the exam. All right, so what did I say to you originally? That my father, even if he goes through a time machine, can't go back and replay his round of golf. So there are problems in backtesting. So one of them is survivorship bias. And I think this gets kind of a glossed over view when I think most of you would know that, of course, if you look back, there are going to be firms that are in existence back then that are not in existence today because they went bankrupt, let's say, or maybe they were taken over by another company. And I think a lot of us tend to say something like, survivorship bias, okay, it's there, but it might not be that important. But let me give you a quick family example. When I think of my family right now, I think of my wife and my 4 children. But if I go back in time, I think of my family as my parents and my 2 sisters. So we had a family of 5. But today, my parents are gone and one of my sisters is gone. So it's just my 1 sister and me. And so if you were to do an evaluation of my family, just looking at today, you would miss all the influence that my parents and my sister had on both of us. So that might not be a fun example, but nevertheless, it illustrates the big problems in survivorship bias. And so don't discount this thing. Look ahead bias, on the other hand, is one of those things where we look ahead, but actually we go back in time and then look ahead to the future and we say something like, oh, of course, I knew that Tom Brady was going to retire in 2022 because all indications were that he was going to retire. So it's kind of like that, oh, I'm certain that I have 20/20 vision even in the past. And so we have a slide with a couple of examples of some look ahead biases. Yes, just remember Tom Brady on the exam and remember things like, there are lags in reporting. Those of you who are football fans will know that the media announced that he was retiring and he didn't make the announcement. In fact, he was pretty quiet about it and said, I don't know if I'm retiring or not. So there are lags between the reality and how this information can get disseminated. Data revisions. I was always fascinated by this going back to graduate school. I had a super awesome econometrics professor, and he had us read articles that were published in top accounting journals, which I thought was interesting, doing all this finance research. But he said, wait a minute, this is what's important because what the accountants are interested in doing is the accountants put out a report, an annual report, and then after a while they go back and they restate it and they say, you know what, we were wrong about that stuff, or some variables change, so let's go back and restate it. So you can do this inside of the firm at the micro level, and then outside of the firm, the federal government is updating its data all the time. So data revisions are important, and then index additions as well. Data snooping, this is clearly a huge problem. This econometrics professor that I was telling you about, he would say to us as we were doing our projects, and remember, when you go through and get a PhD, you got to do lots and lots of independent research, and then you have to write a dissertation. And he would say to us, he would say, look, when you're collecting these samples for class projects, you might collect data on 50 or 100 firms. And he would say, look, you're going to be tempted to go through those 30 or 50 data points and throw out some that you don't like, that doesn't fit with your hypothesis. And he said, don't do that. He used to say to us, you have integrity. And let me go ahead and link this back to our professional standards. Somewhere in there, data snooping is probably a violation of all 7 of those standards. You could probably find a violation inside of all of those, but it's probably most explicitly in performance presentation. I think there's even a standard there on showing the results of simulations and back testing. So clearly this is a violation of the ethics and professional standards that we are learning. And so, of course, really what you're doing with data snooping is you're trying to produce results that you think ought to be by selecting data that you like and rejecting data that you don't like. How's that for an ethical and a moral lecture in the middle of the slide deck? Let's see, historical scenario analysis. This is just one other form of back testing in which we can look at, and this is what the reading does, it tells you about structural breaks and structural regimes. And so think about a break from, some kind of a policy from the Fed that changes, or some kind of differences in volatility. This is why that volatility index is so important, not just for the options market, but for any markets that are out there. When we have low volatility, we have stock prices that are doing this. When we have high volatility, we have stock prices that are doing that. And of course, studying high volatility periods is way more interesting than studying low volatility periods. And then another example, expansions to recessions. And so here's just another example of how we can historically look at some back testing scenarios. So look on the left illustration, there are economic scenarios, recessions and non-recessions, and market volatility scenarios, high volatility and low volatility. And you can see Sharpe ratios for both of those. So you can clearly make a distinction between our original benchmark portfolios and those risk parity portfolios. And you can make conclusions based on the height of the red rectangle and the height of the purple rectangle. And you can clearly make a comment that the risk parity clearly outperforms during recessions. And that's super important to know, because we're always worried about recessions, right? Economies, they expand and economies contract. And if indications are that we might be heading into a recession, well, then this information is probably important. How about distributions? Here's another set of pictures. So benchmark up on the top, risk parity on the bottom. And so notice that the mean is not centered right there for each one, and there's probably a little bit more standard deviation under risk parity. Also look under risk parity that those tails, they don't kind of perfectly hit the parallel point of the horizontal axis, so there might be some kurtosis in there. If you look, maybe there's some tilting up in the benchmark strategy, so there might be some skewness in there. And of course, you can look at these pictures, but you can also calculate skewness, and you can also calculate kurtosis. Now, of course, the easiest way to do that is just to get out your Excel spreadsheet and do it that way. On the exam, I can't imagine that they would ask you to get out your Excel spreadsheet, but you can look at these illustrations and kind of make some general conclusions. Let's go ahead and move from looking backward under backtesting to looking forward under simulation. And what are we told in bold there under that first embedded bullet point? It accounts for the dynamic nature of the financial market. So we have current economic events. So let's suppose we have 10 stocks in our portfolio. So we can divide relevant information into all of those economic factors that are going to influence those 10 stocks. How many economic factors? I mean, there could be hundreds of these economic factors. And then we have these factors that influence inside of each of those businesses, things like dividends and agency costs and board of director composition and all those kinds of things. So we have all of these input variables that we know are going to impact stock returns. So what we can do in simulation is we can say something like, okay, let's go ahead and see how this portfolio reacts if we change some of those variables. And we can do this historically, or we can do this going forward. So the historical simulation selects past results randomly, non-deterministic. However, it fails because history is not going to identically repeat itself. Maybe in a big picture kind of a thing, history might, but it's not going to identically do it. And that's why Monte Carlo simulation is so extremely popular. It is costly and complex, but you think of all those variables that I just described, the economic variables and the firm-specific variables. So let's suppose there's 300 of them. So what this Monte Carlo simulator will do is that it will reach into the bag and pull one of those variables out, say dividends. And then it will establish a distribution of possible future dividends. And it'll change the dividends according to that distribution. It'll have a mean and a standard deviation. Probably won't have skewness or kurtosis. I'll talk about that in just a second. And it can repeat those based on that distribution. And then it can reach in and grab, 300 different inputs. It can reach and grab each one of those. It can do it individually. It can do it in groups. It can do it in silos. It can do it in rows and columns. It can do it however you really want to put together the algorithm. Look at that last one. The disadvantage is that it is complex and computationally intensive. That makes perfect sense. How about some steps here? Determine target variables. And so what might that be? Like the future value of our portfolio at the end of year 1 or year 5. Maybe we have a client who comes to us and says, you know what, I have a bunch of money. I want you to invest it so that I can buy a beach house in 5 years. And I want to buy a beach house for a minimum value of $5 million. And so, all right, so there's our target, $5 million at the end of 5 years. And it could be based on returns. It could be based on all different sorts of things, right? So what are some key input decision variables? How many trials are we going to run? What's the value of the target variable? Random number generator to reach in and grab those things. Distributional properties. We're going to just keep this over and over again. And then we'll go ahead and compute future value or some kind of a terminal value or a holding period return or an internal rate of return. Now, this is an interesting slide in terms of being able to multiply what history has set for us. So I want you to look at that illustration on the right. So here's our original data set going down the blue column. And so those pieces of information represent a portion of the portfolio. But what we can do with historical simulation is we can reach in. So think of your hand grabbing into each one of those blue rectangles and pulling out a whole bunch of stuff. And then rearranging it so we have the green column over there. So we've got, instead of just 100 data points, now we have 1,000,000 data points over in the green column. And notice the percentages on the green column are fairly equal. I mean, they're not identical, but they're, somewhere within reason. So that you have a multiplicative effect on the original data set. Some of you might remember that this is called bootstrapping, and it has a couple of other names. Bootstrapping was what we did back in bond pricing. All right, so here's a little bit more of a granular slide on the inputs. So let's go back to our benchmark and risk parity portfolios. So we need those target variables. So let's just go ahead and decide returns. The returns of the 8 underlying factor-based portfolios. We're going to do this 1,000 times. And so our reaching hand into the silo, we call that bootstrapping. So we're just going to pull out a random number, whatever it is. We're going to assign that a month. And then we're going to select some other kind of random number and just find out, okay, are we squeezing it in like this or are we pushing it out like that? Draw the 1,000 numbers randomly, select 1 month, repeat for months, and then calculate those performance metrics. Now, with Monte Carlo simulation, we're going to do almost the same thing that we do with historical simulation, which we just did. However, what we're going to do is we're going to say something like, you know what? The future can hold almost anything, right? We want to be able to say that our model is going to capture all possibilities for the future, which means we of course want to consider the mean, we want to consider standard deviation, but we might want to consider higher moments of the distribution like skewness and kurtosis. And so when we use this Monte Carlo simulation for the future, we're putting these variables into their functional form and we're saying something like, All right, let's draw a distribution. Let's just do a normal distribution, right? There's that bell-shaped curve. And we have all of these different possibilities, and we're just going to keep grabbing and keep grabbing. This is called model calibration. And when I say we, I don't mean me, because I'm clearly not skilled enough to be able to write the algorithm for a Monte Carlo simulation. Hopefully, many of you are. Now, the issue is that there have to be some pieces of software out there that do this in there. Lots and lots of stuff. All right, what are some key considerations when choosing those functional forms, right? The distribution should describe the key empirical patterns, right? So it makes sense that if we're doing something like dividend yields, that we consider profitability and some kind of an historical pattern that can repeat itself throughout history, right? We don't want to say, oh, I want to buy stocks that have 100% dividend yield. I mean, that doesn't make any sense. Once again, these correlations and covariances between and among key decision variables, we need to make sure that we can accurately either compute them or estimate them or pull them out of those distributions that we have confidence in. Now, of course, there's always a trade-off. So there's a bias variance trade-off. So these highly complex models, they're going to write low specification errors. So you're getting your vice and you're squeezing this down, but they're going to have large estimation errors. Overly simplistic models, they might be totally worthless. And so there's always a trade-off. Now, the Monte Carlo relies on this multivariate normal distribution. And so what we're going to say is that we're going to pull out these variables based on means and standard deviations and covariances. And since it's so complex, we can't add to the complexity and add skewness and kurtosis and tail dependence. We can try, which is what I said just a little bit earlier. We can try to capture that. And I think that was in one of our earlier illustrations where we had one of those that was a little bit tilted to the left. We can try to account for it, but because that can be so complex, it's super difficult to do that. So what we do in order to account for skewness and kurtosis is that we move to sensitivity analysis. And so we're going to use this multivariate student's t distribution because it can do just that. However, we need large number of parameters and more mathematically complex. So here are two more illustrations. We can do a Sharpe ratio. We can do a conditional value at risk. And remember, value at risk is an interesting concept because it shows you that cutoff. Let's suppose we want to do 5%, right? So it shows you that the amount of loss that you can expect 5% of the time, but that's not your maximum loss. That's just your minimum loss. So that's the beginning of the tail. And so conditional value at risk goes from the beginning of the tail all the way to the end of the tail, and it computes some kind of a mean value. What do we call that? Expected exposure down in that left value. So here we go. Conditional value at risk. This is super important. Sharpe ratio, of course, that's super important. And we can use this to compare. Well, what did we do? We did backtesting, historical, old time Monte Carlo, and new time Monte Carlo. And so let's just be careful with the costs of Monte Carlo simulation versus the benefits of being able to make these models more complex. All right, how about we end up here quickly with some discussion continuing in our sensitivity analysis. So Sharpe ratio shows that the RP allocation outperforms, right? So that makes sense, right? There's the purple. The downside risk is sensitive to the choice of simulation. Whoops, I went one too many. Oh boy, so we do this conditional value at risk, backtesting and historical simulation. Boy, that really shows up there, but it doesn't show up under Monte Carlo. So we need to take a step back and say, which one of these models, here, let me go back here. Which one of these four models that we use are we most interested in? And like many things, I'm guessing that when we are looking at some kind of a strategy today, like my original dividend yield, we're probably going to do some of each of these 4 methods. And that takes us through our learning outcome statement. So what's important? Think of my dad traveling through time backwards, traveling through time forwards, and all the problems that's faced with him. And then let's move to our dividend yield example. And so this is super valuable going back to the past or estimating the future. But we need to be worried and concerned about the marginal costs and the marginal benefits. So I had fun making this recording. Thanks for watching and good luck studying.